Well, welcome to Quiver Financial's weekly market update for February 14th, and happy Valentine's, everybody. If I look a little worn out, it's because I got to spend my Valentine's Day getting a colonoscopy. Nothing like a date with a doctor. So if you don't got enough love, you can get plenty of doctors. Good news is, clean bill of health, folks. So I'll be around for a little while longer to irritate you and talk to you about markets. Let's get into what's going on this week because we had a lot of things happening between Trump's tariff announcements, a CPI report that had a little spike up in inflation, which caused interest rates to spike up and threaten some of our interest rate sensitive investments. We had oil just pivot right at the right place. And gold, boy, oh boy, does it not stop going. So we're going to show you a few different things that we're watching this week to be big tells for next week. Main thing is, let's start with gold. Grandpa's gold is beating the pants off of crypto. So we're going to show you how high it may be able to go. Then we're going to talk about oil and energy because it may be the one thing that's determined to upset Trump, because the only way he's going to be able to bring interest rates down is to bring inflation down. And the number one thing to inflation is, of course, oil prices, and they are not behaving the way he would like to. So you got to see what's going on in the charts there. I'm going to show you. We're also going to highlight, again, the stock market because it did what it needed to do this week for the bulls to stay in control. So is it off to the moon or should we expect a crash? I'm going to show you our key levels that are helping us manage risks into this next few weeks. And then also interest rates and REITs. That's actually where we're going to start because I still believe that this year the most important story is the story of interest rates. And we're talking about, is inflation back? Because we got a CPI report on Tuesday that was a little too hot and caused the 10-year Treasury to spike up and almost make us make an action. So I'm going to show you those levels that we're watching. I'm going to show you what kinds of actions we consider. And more importantly, I'm going to show you what's gone on in some of those traded REITs we talked about, like Annaly and what was the other one? EPR Properties. So the performance of those you got to see as well. So let's jump right into it. Long term, our theories have been that interest rates are in this Goldilocks zone of 4 to 5%. I'm going to show you that on some charts. If we stay in that range, we can continue to be investors in non-traded REITs or other interest rate sensitive investments. We're also going to capture a little conversation on the stock market. I'll give you our new levels that we're watching for on either for whether we're adding to our stocks or subtracting. And then we'll get into the metals and gold. We'll talk about this move because it's really starting to get mature. I'm going to show you a couple levels we're watching as far as our areas to maybe take some profits. And then, of course, we'll talk about oil, Trump's bane here, because the oil markets did exactly what they needed to do this week to be totally undecided. And we're going to need another week, but boy, is it going to make a big difference. So let's get into interest rates since we think that that is the big key factor. I mentioned to you our thesis this year is we'd love to see, and we do believe that the 10-year Treasury is trying to stay between 3.5% and 5%. If you're somebody who watches mortgage rates, it means you want to see mortgage rates under 7%. If we can stay in this range, and a lot of good news and bad news can happen between these 2 points, then interest rate sensitive investments like treasury bonds, utility stocks, non-traded REITs, things of that nature should perform fairly well. And if interest rates actually trend lower, they should perform great. So I'm going to show you a few charts of the ones we've been watching. The main thing that we're watching right now is on the 10-year Treasury. We saw earlier this year, it pivoted right where it needed to. It hit 4.76. The Fed's been pausing their interest rate conversations. Since then, the rates have trended back down to our first target of 4.5. And we sure would love to see it down at 4.25, because down there, our confidence level of that Goldilocks zone remaining for longer is a lot higher. Now, something happened this week that gave us a scare, because all of a sudden this week we have a situation where we get this little danger, Real Robinson. I mean, just boom, this big spike up in the 10-year. It jumped from 4.46 to 4.65, 4.63, somewhere around there, which I didn't mention this last week, but my thought process at the end of last week was if rates turn higher here, where's my line in the sand? And I was thinking, probably around 4.65. Well, rates spiked right up to 4.65-ish on that CPI report. And then the very next day, reverse course. And we ended the week right below that 4.5 level. So we've ended another week right below a key level. I have a feeling that next week we may head lower to that 4.25, and I'll show you why. Because, well, before I get there, let me show you short term what happened in the week. So this is what I'm talking about is the CPI report that popped out on Wednesday and spiked rates up. And so now what I've done, and this is a little inside baseball on how to manage risk, is when you have a big long-term picture that is, hey, we don't want the 10-year to give above 4.76. This is like my stop loss level, that if rates get above 4.76, then I've really got to start to reduce our positions in anything interest rate sensitive. Now that the market's wiggled around a little bit, it's given me a new tell, which is that 4.63 level. So this is the level that now, we'll call it 4.65. This is the level now that I'm going to watch, because if we get above that, I may start to advance my risk management techniques of reducing positions sooner. That way I can keep some of the profits that we already have. Now, if we break below 4.4, nothing we need to do, because that's what we want. So the reason I think that next week we could possibly bounce back up to 4.5, 4.55, and then eventually work our way down is I'm just watching the action in the traded REIT sector. And you'll remember back in January, let me move my picture so you can see the date. You can see here back in January 10th, we had highlighted EPR properties as something that had held a line of support and looked really good with a target up at 50. So 44 to 50 is a nice move on something that pays an 8% dividend. And the volume was increasing at the same time. So that just gave us a little heads up that we might want to pay attention here. Since then, as you go into this week, that 44 was a great entry level. The trend line now we can, and another piece of inside baseball on managing risk is that when you start to see, once you have an entry point like we do at 44, we can now manage that risk by drawing this trend line. And if interest rates move lower next week, maybe this uber bullish trend line stays intact, because that's now my first risk management tell. A break of this at any point in the future will cause us to start to reduce some of our positions and keep some of the profits that we have. We really would love to see it get above 50. So this takes me back to the point of why I think next week or in the next 2 weeks, you could see rates trend back down towards 4.25, is because if big money managers, if people who are managing lots of money believe that interest rates were going above 5%, I don't think they'd be allocating a lot of money. I've said this the last couple of weeks. It's just another tell. Annaly Capital is another one that I watch. We pointed it out. What was the date here? This was the beginning of January. We pointed out that if it could hold 18, maybe it runs to 21. Well, here we are. Little did I know that only needed a couple weeks, because as an update, let me move my ugly mug. You can see here that we've hit almost 2150. Now, with both EPR and with Annaly Capital, I do expect that they should get a little pause here. So if you're not in these names, I wouldn't be chasing them right now. I'd wait for a buyable dip, right? But for us, Quiver clients these have been on our radar. Now we're in a position of managing profits. We've collected a couple dividends on them. So the whole goal here is to draw trend lines and make sure they hold. And if they break, we take action. So that's what's going on in interest rates, traded REITs, treasuries. They still look healthy. They still look like a place that investors should be interested in looking at if they're looking for both income and growth. Now let's move into your grandpa's gold. The one thing that's kicking crypto's butt the last 3 weeks. I mean, everybody wants Bitcoin and Solana and Ethereum and XRP, and they've gone nowhere the last 3 weeks while grandpa's gold. Oh, I'm getting ahead of myself. So let me skip to that. Whereas grandpa's gold just keeps running away, folks. As you can see here, after that breakout in gold, we asked last week, would we get a little bit of a correction back down to support and then off to the races? Right now, after this week, I'm not so sure. Do I have a chart for this week? Let me tell you. Yeah, so this is the chart I showed you last week, where we had that solid breakout, and now this week we've built upon it. Gold's up another couple percentage points. This question is, a normal behavior would be for gold to correct down to this level of support, which used to be resistance, and then go off to the races. But the way it's been trading this week, I just have a feeling that it's just this slow grind higher for gold. Our first target on it is 3,000 and then 3,200. Once we start coming into those levels, we'll start to do some risk management. We've been in this position for a while, so we wouldn't mind taking some profits and moving on. So I'll update you that over the next few weeks. So now let me go back to oil. I skipped through that because I got so excited about grandpa's gold. The market of oil we've been talking about for a while, because for years we've been in this consolidating pattern that anybody who's watched for a while is probably getting sick and tired of hearing of. But these patterns, when they break out, like they did in January, they tend to be a trendy multi-year move. And I know there's drill, baby. There's Trump wanting to bring prices down. I get it. They can do anything they want, but the markets and the charts are going to tell you whether that's going to happen. So after this breakout, another tell we were looking for is, would we get just a shallow correction and off to the races, or would we get a deep correction where we have to come back and retest that level of breakout? And what we got is we got exactly that. We got the breakout and then a good solid test of that breakout level, right around 76 on USO, about, call it around $76, $77 on the barrel of oil. This week, last week we said this week was a very crucial week. We came into the week with Trump talking tariffs. And we got a little tariff bump that got me all excited, because you saw here gold ran up to 78, and I thought, oh boy, here we go, people. And then we ended the week right back where we started. So I would be really more motivated. I'd be much more confident if we would have stayed somewhere up here in that 78 range. But this is still totally acceptable as far as like the testing support, because this was resistance, and the rule is past resistance is future support. So now what we watch over the next 2 weeks is, can we hold this level? Can we springboard off of it, or do we dip below? For us, what that means in your energy sector holdings, if you look at a sector of energy, it means that this 88 level on XLE really becomes our main line of, this is bullish or bearish. Above 88, we believe in energy. Below 88 doesn't mean we don't believe in it, but we just need to now reduce our allocation because it doesn't have momentum. So that's the other part, is you could have a totally great story, fundamentals, everything matches here. But if there's no momentum, then there's no reason for us to stick around. So what I'm watching is this trend line that's starting to form here that I call the Uber bull line. Right now, I think it's pretty low probability that the market trades off of that, because that would be a pretty bullish move. Would love to see it, but I'm not so certain. I have more of a feeling that we bounce between 88 and 90 for another week before we see the next move. So for all of us energy investors, we're just going to have another week of patience, but we got to keep on it. We got to stay paying attention to it, because this next move could really make or break whether you have profits or losses in some of these things. So the next 2 weeks, the rest of February, I think is really, really crucial for people to pay attention to. You don't need to worry about that chart. We already talked about gold. So let's move into the last section and wrap it up, so all of you guys can, and gals, everybody can have a nice Valentine's Day that was at least better than the way mine started. And let's end it with equities. We've been talking for a while that if you go back to the Great Recession to now, we have a pretty clear 5-wave Elliott wave pattern in the equity markets. What that just means, it's a warning sign. Fifth waves are usually the last wave, and then you'll go through a phase of either correction or bear market. Since this is like a 12 or 14-year bull market, we should expect the next consolidation phase is probably going to be more than a couple days, should be a few months, if not a couple years. Don't forget, from 2000 to 2010, the stock market did have the lost decade where nobody made money in stocks for 10 years. Hard to believe that happens, but it does. It happened in the 70s. It tends to happen when interest rates are a little uncertain and there's inflationary factors. So just heed the warnings that we're getting late in this cycle of the market. It can keep pushing higher because so far this week, it's given no reason to stop. But I just forewarn everybody that if you're a new investor to stocks, be careful, be smart, pick value, keep some cash on the sidelines in case things turn on you. It's always nice. If you love something at 100, you should really love it at $20. So always keep some cash to buy more on a dip. So this is what happened this week. Last week, we also, part of our warning, we talked about, hey, all the small investors are in. If you've ever heard this, statement that the last investors into the market are the retail investors, well, they're all in now, folks. There's not that many people left to push it higher. So that's why it's important to start looking at the S&P, the NASDAQ, the Dow Jones on a weekly basis, because if and when they turn, that turn could be pretty rapid and fast and surprise you if you're too complacent. So last week, we shared with you that we had this zone where this warning zone, basically just below 6,000 on the S&P 500, that if it got below, let's say 5,900, then we were like, okay, sure, we're in correction mode. This, in the last couple of weeks, the market, since December 1st, the stock market's gone nowhere. It's gone sideways. Gold and everything else has done much better at the start of this year. And so now what I'm watching is this week was really, really constructive. We ended last week kind of concerned that we could break down. We never even got into this warning zone this week. We just kind of constructively built stair-stepped higher. We're now just slightly above that 6,100 level of resistance. So now what I'm watching is next week, maybe we start off a little low. Do we come back down to 6,100, test it as support, and then go after the races? Because right now, it looks like the bulls are in control. The bears have a couple plays they can pull here, but they're really running out of ground. If they don't show up Monday or Tuesday, then anybody who's betting against the market shouldn't. And I wouldn't be doing big bets against the market right now because the momentum is higher. So you stick with that. The trend is your friend until the end, folks. So for right now, even though we have concerns around the stock market, they're not concerns we need to act on. I'd like to wrap it all up with asking you guys to please like and subscribe the videos when you get to them. We've actually gotten some momentum, which I really appreciate. Next week, I'm going to share some more inside baseball. I want to share with you guys a few of the stocks that I'm watching to add to the portfolios if they do certain things in the next few weeks. So I'll teach you a little bit of how to create a buying list and then what things to watch for, little triggers to give yourself buy signals if there's stocks that you're looking to have. Until then, folks, enjoy Valentine's Day. Have a great, President's Day weekend. Hopefully we get some good weather because we've had a lot of rain here in California. Rain and fire. So until then, take care, folks.